So I'll take you guys kind of through a tour of what's working and what we're doing next. But I like starting with what our name is. The name Ackroo initially was about accruing rewards and accruing customers. But after I took over in 2014, 2 years into the business, we made a shift where the businesses have been about accruing companies and offerings. We're in a very fragmented marketplace in the gift card and loyalty and payments and point of sale world. And you're seeing this massive consolidation happening. So we've been very focused on consolidating that marketplace and being a thought leader there, everything from gift cards to loyalty to marketing to data to payments and point of sale. But that's been our vision. It's, how do we consolidate a really fragmented marketplace, simplify it down for our merchants, meaning instead of having, 5 vendors to deal with, they could have 1 vendor to deal with, but improving it, making it very self-serve. So unlike the traditional marketing industry that's very services heavy, we're a tech-first company. So it's all about self-serve, easy to use technology for our clients so they can do all these things themselves. So we've taken this both vendor and industry consolidation approach and technology first to kind of go to market in a few different ways. And for the first 8 years of the business, we were a marketing company. We built this self-serve data-driven platform after acquiring a company called MoneyBar out of Vancouver and focused on loyalty and gift cards and promotions for businesses. And that was a very good approach for us. Marketing was a necessary aspect to a business. But what we did over the years is we learned that we wanted to expand our breadth of offering because how we won our marketing clients was through our payment and point of sale partnerships. So companies that would sell debit and credit services or point of sale software would refer us into their clients, and they still do today. But we realized for us to kind of embrace the consolidation that was happening in the industry, that we also wanted to get into those two areas of the business. So over the last 12 months, we made a big shift where we've now bought our first payments business a year ago, literally a year ago, April, and we got into the payment processing business. So now our clients that use our marketing platform can get debit and credit rates from 2 of our main partners in both First Data and Global Payments. We, at the end of the year, purchased a point of sale company to provide that operational piece. So now we have a marketing solution, a financial solution, and an operational solution to go to market with. But from a point of sale perspective, we didn't go broad. We decided to go very niche, and we went after a golf course point of sale to start. With things like COVID happening, we thought it'd be smart to go after specific niche markets to start and to expand from there. So we actually went after a golf course point of sale solution. So that's kind of our toe in the water on point of sale. But our approach still stays true that we're a consolidator first, both a vendor and industry consolidator, but for small to medium-sized loyalty marketing, payments, and point of sale solution providers. We've been doing it through an innovative approach, like I was mentioning before, about self-serve, but we're also trying to take a very strong data-driven approach where we get lots of loyalty data, lots of operational data, and now financial data into our product. How do we then capture that information and present it in a meaningful way and then provide all these tools we have, email marketing tools and campaign tools that we have for our clients to have them engage their customers. But the last thing we're doing is integrating. We're not just integrating when we acquire businesses, because a lot of the Frankenstein that we do is, we buy a company and we integrate their assets into our technology. So we have our own platform, we build up, feature parity and then move them over. Maybe we use a few of their assets, but we don't do everything. Like from a BI perspective, we integrate a third-party BI tool. We integrate a digital marketing tool like a MailChimp or a Dialog Insight into our platform to do email marketing. So we're not building all the pieces, we're providing all the pieces. So we build the core piece and then we partner and integrate in these different solutions. And we've done so across 4 different verticals. And as time went on, both through acquisition and just some organic growth that we've done, we started to win in multiple verticals, not just traditional hospitality and retail, which is where all of our competitors play heavily. We started to win in petroleum. So think gas stations and quick lube places. We have traditional hospitality like quick service and table service restaurants, but we also won a lot in automotive. We've got a large reach across automotive, which is primarily car dealerships and automotive services companies. And then general retail is kind of the catch-all for all of our businesses. But this diversification of solutions has helped us in times like COVID, where not only do we have multiple solutions, but we have multiple verticals. Where for us, the retail vertical took a big hit with COVID. That's where we saw a lot of the bankruptcies and the challenges from what's happened there. But areas like gas stations, they stayed open. Maybe people drove up a little bit less, but they still stayed open, and automotive was the same. And restaurants, they just pivoted. And they pivoted to more things digital. And things like our digital gift carding business doubled last year because all things digital was the future. And we most recently even announced integration to Shopify to sort of embrace that. So our business weathered the storm of a difficult time. And even though we're still not fully out of COVID, this diversification has really helped us. I mentioned earlier that our business was foundationally a gift card and loyalty business, which it was. And that good to have business of gift and loyalty and marketing and data is really important for a business. But again, why we tacked on payment and point of sale was to have necessary products. Businesses have to have operational management. They have to have financial pieces like taking debit and credit rates. So now we have a very good to have solution along with very need to have solutions as well. So this is an important part of our story and what's new over the last 12 months for the company. We're happy with the results of our business. And like you mentioned in the introduction, we've had very solid growth. Our average CAGR since inception has been about 34%. The only flat year for us was the year I took over, which was in 2014, where the business went through a major shift where we changed not only leadership with myself, but even the commercial model. We're going from a direct sales model where we were spending a lot of money to organically growing through channel partnerships and through acquisitions. And that pivot through channel sales and inorganic growth has really done well for us as a business, where we continue to sort of grow year over year over year. And even last year, in a year like COVID, where we had double the attrition we typically have, we still grew well. And our audit financials will be out in a few weeks, but we're very happy with where we were from both a revenue and earnings perspective in 2020. Our EBITDA story is similar. We're like a typical SaaS business. You have lots of losses early on, but over time, it's a little bit of money over a long period of time. And it's really just sort of getting over that tipping point of profitability, which we did in 2018. So after a few acquisitions and some organic growth in the business, we really did do well, and we turned into a profitable business. And as you can see, the EBITDA continues to grow materially because the bulk of your costs in a SaaS-based software business like we are, it's people cost. So we don't end up adding the same amount of people cost relative to the amount of revenue now. So there's this massive earnings contribution that continues to happen for the business. From an approach standpoint, we kind of have, a cross-sell approach, which is a big thing for our business. So organically, we expect even bigger growth than we've seen in the past. We've been a single-digit organic growth business over the last, 8 years, 9 years that we've been around. We've been primarily an inorganic growth business. But now that we've got multiple solution sets in marketing, point of sale, and payment, and now that we've got a very defined marketing product, the cross-sell aspect of our business is a big organic growth driver for us, where we see the ability to go to our 5,000 plus customers and start cross-selling and upselling our business, working with our product partners to sort of introduce our technology to them, but also going back to direct sales. Because now we can go knock on any door and say, do you need a payment solution, an operational solution, a marketing solution? We don't need to rely on our partnerships. We leverage our partnerships. We don't need to rely on them. So that's a big shift for our business that we should have one of our best organic growth years ever this year in 2021. The technology itself, again, is going to be continuing to sort of evolve with that integration and expansion of the solution set. But the other big thing for Ackroo is geographical expansion. I've got a slide that I'll show you lately about what we did last year just geographically. But as you can see below, only 7% of our revenue comes from the US today. 93% of our revenue is Canadian. So there's a big US expansion play for us where it's 10 times the market. But as we go down there through partnership and through offering, our product works in the US today. We can sell there already. There's a massive play for us to kind of expand both geographically into our business. Our inorganic story has been pretty steady. We've done now 10 acquisitions in the last, ever since I've taken over, with the multiples being about 2 times revenue, a low of 1.5 to a high of 2.5, but that's been our revenue multiple. But for Ackroo, from an earnings perspective, the goal is to take these businesses that are primarily private and, bring their staffing into our environment where we go from a break-even business to a very earnings positive business, where we get 40 to 50% earnings out of the business, where we try to contribute 20% back to the business and 20% into earnings into the company. And we do that through a number of things. You take like a GG Golf business last year that we bought in October, November. It was an on-prem business. We're moving it to a hybrid technology. It was very lumpy in its revenue, where in Q2 is when all the revenues would come. So fundamentally, next quarter is when you'd have this big $1 million of revenue hit. We then take it and smooth it out. We move everything from this lumpy business that is all charged and collected all in one quarter, and we smooth it out. So we've spent 5 months now redoing contracts, smoothing out monthly payments. So we'll actually see, instead of this big spike of revenue in Q2, we'll see a smoothing additional revenue in Q2 onwards from a business like that. We address the technology, and we also traditionally reduce the team. And that method produces a more efficient business because we already have finance and operational and product people here. But it actually, allows for growth and scale. And so the other part that we've been really focused on is early days, it was a lot of stock-based consideration. But now that our business is profitable and we're in a position to whether get cash through equity or through debt, we have and even just through our own earnings, we're doing a lot of cash deals now, where that's going to be a trend as we sort of move forward. The last two nuggets to know about is that, from an integration standpoint, how we decide to do deals has a lot to do with the speed in which we can integrate. Last year was a big year for us because we did 3 acquisitions, albeit small. But when we do a deal, if we don't believe we can take the business and integrate it into our business within 12 months and normalize it to get those 40 or 50% earnings I was mentioning before, we don't do it. So even right now in Q1, we didn't pull the trigger on an acquisition, not because there aren't opportunities to close. It's because between the deals we've done over the last 12 months, we didn't feel we could actually do an acquisition and normalize within 12 months yet. So we wait for that timing. So it's not just, is the deal right for the business, both in the consideration, the intrinsic value, and can we normalize it? But also is the timing right from a technical debt perspective. So we wait for that timing, and a couple times it's hurt us when we actually went over that 12-month timeline where it affects your organic growth and your next inorganic deal. So we're very patient and timely, but we still believe we can still acquire 1 to 2 deals every single year while getting this organic growth going. And every time we do a deal, we focus on more than just a good deal. We're trying to add more for the business. Early on, it was adding gift card fulfillment or automotive or mobile. So we're always adding intrinsic things, and lately it was payment and point of sale. But now we're also looking at adding talent. How do we add in more key talent at the senior executive team to help join myself and others to really build out the business in a bigger and smarter way? So there's a lot of value to the acquisitions, even though the organic business is starting to get some steam. Inorganically, we've got a model that works well, and it's paid dividends for us, so that's going to continue in the future. And the biggest benefit, to be honest, for COVID for the business, outside of embracing a digital environment, is our M&A funnel actually doubled last year. So we went from 10 opportunities and about $30 million of annual revenue that we were talking to now double that, where we have over $60 million of annualized revenue that we're talking to on an active basis right now to combine into the Ackroo business. So COVID's played well for us in that respect, where a lot of businesses are looking, that are privately held, saying maybe it's better together with Ackroo, or maybe it's time to move on to something else. So it's bode well for us. I've mentioned a number of the strategies for us inorganically, and again, it is a big part of our story. But so we do expect to continue to do so this year, getting a deal or two done later in the year this year when the time and opportunity feels right. We will expand our solution, our reach, but really we want to sort of double down on these 3 core areas, on point of sale, payment, and marketing. We don't believe we need to add a 4th pillar to the business. We have 3 pillars that we kind of want to double down on for the next couple of years. So as you see in the future, the announcements that'll happen for us will be around doubling down in those areas. We're happy with our financial metrics. We've been a 95% retention rate in our business for the last few years. Last year was double the attrition. We saw a 10% attrition rate in 2021, and we even saw a 10% attrition rate in Q1 of 2021 as we head into the year because of COVID. So heavily in areas like retail. So we've had a higher attrition rate since COVID started, but we think that's going to flatten out and go back to what it traditionally was at that 95% retention rate. Our gross margins are high. Very high recurring revenues. So when we go into a quarter, 80% of our revenues are very predictable. It's only 20% of our revenues that's kind of variable for the business. And what we did well, that I think what we've proven out is on a $6 million business last year, we will have generated a 20% EBITDA margin in our business, give or take. And so if we've been able to prove that at a $6 million business, we think we'll be able to do even better at a $60 million business as we kind of scale things out. From a cash perspective, we do have cash in the bank. And because we are cash flow positive, that cash slowly increases as we move forward. And the fact that we've done 10 deals, not only does it mean that we know how to do it, but the market is now aware that we're an acquirer. People are becoming more aware that we're in the interest, we're in the business of acquisition and doing it well, that we have more people knocking on our doors than we are knocking on theirs. So the milestone story for us is really very M&A heavy. Instead of rebuilding the technology early on, it's been acquisition based all the way along. From a business model perspective, we have a one-time setup fee to get onto the platforms, whether they're a marketing platform, the POS platform. Our clients then pick a monthly subscription, which range from as low as $25 a month to $1,000 a month per location, with our current average being about $83. And then if you add in other recurring revenue that we have, like payment and point of sale residual commissions that we get, we're seeing about $99 per location per month. So there really is a 10x opportunity just organically in our business. Now, fundamentally, we're not going to have all of our customers paying us $1,000 per location per month. But if they were loaded up on all of our products and services, that is the revenue potential for us as we keep scaling out our business. And so can we double or triple our business organically? We believe so. Going from $100 a month, even $200 to $300 a month by providing more services, by having all of our customers embrace not just marketing, but also point of sale or also payments for us. So there's a big organic growth upside for us. And the last is there's still going to be one-time revenue. There still is custom development that you'll do. There's still collateral that gets purchased, even though we're a very digital world and a mobile world. You'd be surprised how much plastic and paper is still ordered for direct mail and plastic cards and key tags. So there still is a revenue stream that happens there. Even though it'd be smaller, it still exists for the business. So our past was a gift card and loyalty business that we partnered in for the other areas. Today, we still are a gift loyalty business that has a marketing offering, a payments, data, and POS solution. But I mentioned earlier, we're making a big shift towards data, where we're embracing that data. We have all the tools now to take that data, present it, and market it. So we're bringing it all together so it'll be a very data-driven business across 3 solutions: our payments business, our marketing business, and our point of sale business. From an addressable market standpoint, it's quite large. The main graph you're seeing is around our marketing business because that's what our foundation has been. But you can sort of see we've even taken a niche market in marketing. So we took a niche in both automotive and petroleum, where 1 in every 5 car dealerships in Canada uses our software. And 1 in every 11 gas stations in Canada are using our software today. So that's it's worked really well in Canada for us. And obviously the US market's even bigger, but we've done well in being a bit of a me too in hospitality and retail, and we keep to expand there in marketing, but we've got a niche market in marketing. And it's why we thought we also want to take a niche approach in point of sale. And again, we started with golf clubs. We have 160 of them today across the 20,000 that are addressable market for us. But it's not only niche in golf, but it's primarily a semi-private and private golf course solution. So we've taken a broad but also niche approach to the market that seems to be working really well for us. I mentioned earlier about our clients and where we're winning. And this is a bit of a heat map. You can see kind of all of our clients, and it's very heavily in Canada today. But if you look last year, both organically and inorganically, we're starting to penetrate the US, primarily very East Coast. But we are starting to spread our wings in the States, and we think this trend is going to continue. And you'll see as future updates, as I do in future quarters, we'll talk a bit about that US expansion and what it's meaning to the business. Our businesses consist of kind of 3 groups. We have our large merchants that are primarily came to us through acquisition, small merchants, which has come to us really from the early days of our business and a lot of the self-serve stuff that we did. But our focus as a company has been those mid-market brands, those 5 to 100 location businesses that we provide a lot of value for. And so for us, that's a sweet spot for us, both on a value of services and a revenue per location. So for us, that's a big focus for our technology, our team, and our marketing. Partnership's been the play for us moving forward. It's all been about, where do you partner, how do you partner? And every quarter we add a new partnership. We just announced Shopify last week, for instance, and every quarter there's another new one. Our industry is very fragmented, gift and loyalty, marketing, payment, and point of sale. But all of us are competing, we're partnering, we're consolidating. So it's a very active space. The consolidation is something we had to embrace and we did early on, and it's bode well for us. So how do we differ? A bit of our focus has helped. That is for all merchant sizes and across multiple verticals, our breadth of offering that we have. But I'd argue even our public currency is a unique thing. There is very few public companies that are at our size in our space. Anybody who's public in our space, like a Lightspeed or a Shopify or a PAR, they're much bigger companies. So we've got this sweet spot of smaller companies. And why does that work well for us? Well, when it comes to acquiring, there's not many people buying those less than $5 million a year businesses. We do. We bought the $100,000, the $1 million businesses because we can kind of roll them up, rinse and repeat, and it works well for us. So that public currency not only creates awareness for us when buying, because if we do end up paying in paper, that paper is liquid. But more importantly, it kind of creates an awareness of the marketplace that we're out there, we're consolidating for all those smaller guys that are knocking on our doors. So the last is on the investor side. I think it's of great value as an investor for a number of reasons. Our market leadership, we are a cloud-based solution, all the data we embrace, what have you. But our organic CAC is strong. $1,000 per location to a $9,000 LTV. And if you think about it, we're actually getting that $1,000 back in the very first year on that $100 a month business that we have. So we've got a really good model organically, and we've done very well inorganically for the business. So much so that we think this is going to continue to sort of trend in the future for us. From a shares outstanding standpoint, we have a little over 100 million shares outstanding. We do have warrants. The 10-cent warrants were just accelerated because we have traded above 20 cents for the last 30 days. So those have been accelerated. But from us, from a market cap perspective, we're trading at, 4 times last year's revenue, 3 to 4 times this year's revenue. So, we feel like we're valued at a good price, but at the same time, lots of upside for the business. And we're tightly held. 30% of our shares are held by management and people like myself, and there's 30% with other insiders. So there's only really a 30 to 40% float that's out there. Our management team consists of myself and our CFO and a bunch of senior leaders. But the other thing to know about is our board of directors. We've attracted some very strong leaders around the table, from corporate securities lawyers to to technology founders, and even our most recent board member, Francis, who joined us, who's also, I believe, a board member of a couple of other companies that presented earlier today. So we've been able to attract and assemble a lot of talented people around the table to support our journey, which sort of validates that we're on the right path, and that, more importantly, we have the right people to help us stay on that path and accelerate forward. So I'll stop there and answer any questions.
Yeah, thanks so much. So I'm just going to kick off the Q&A. I have a few questions. So let's start just on the consolidation side, since that's been kind of your primary strategy to date. So just for M&A, so how much, I guess, is your strategy dependent on accessing the capital markets if you guys are starting to pay more in cash for deals? And then can you just talk about maybe the backing that you have behind you on the financial market side of things?
So it was important for us that we didn't just get a financing last year. We wanted to get like a financial backer. So the financing that we did in the fall of last year was a $3 million financing. But if you read the PR on it, it was really 4 people. It was the Shen's Fund, which they have a fund. It was one of our board member, Jason Donville, who's heads up Donville Ken Asset Management. It was his fund. It was the Rivmont Fund, which Matthew talked about. And fourth, it was a family fund that's been with the business since I took over. So we've got funds that are around us now, which is a new thing for Ackroo, right? We were typically a retail investor funded business, but now we've got some funds to sort of backstop us and fund us moving forward. And as we get better capital appreciation, it'll make more sense. But we don't want to not use our stock. So when our stock is at the right value, where it makes sense to do deals, like if you're trading at 4 times, you're buying at 2, not such a bad idea to use your stock, right? But when you're trading at 2 and if you're buying at 2, it's not as ideal. So there's a bit of finessing that we're doing with regards to when we inject capital and when we don't. But even from a warrants perspective, there's over $5 million of warrant capital that's going to come into the company over the next little bit. Never mind the $2 million we have in the treasury between the last deal. So for us, we have some capital early on that we have access to today that we can pull on. But there's future capital access through the different funds and groups that we're working with today to help fund our growth goals.
And then how large are the businesses that you're typically buying in terms of revenues?
A lot of them are like less than 2 million. I said 5 million earlier, as that's our sweet spot, but you'd be shocked how many $1 to $2 million businesses there are. Because I feel like it's easy, what we've noticed anyhow, it's easy to get to $1 million business. It's a lifestyle business. I pays for my boat, pays for my cottage, and I got a lifestyle business, but it's hard to scale in our industry. The barriers to entry to get into what we do is low. The barriers to scale is really hard and really high. So they all get to like $1 or $2 million of revenue. And then at that point, it's like, at what point do you just move on from your family lifestyle business to sell it and let somebody else scale it for you? So that $1 to $2 million has been the common. But as we get bigger, those numbers will get bigger too, right? As we get larger as a business ourselves, we've always bought smaller than ourselves. But that's what's been historical.
I guess then, are there any larger consolidators out there doing the same thing that you're doing, looking at, Ackroo as like their sweet spot of business? Like, is there anything that you guys are aware of?
Well, yeah, people knock on my door all the time too, right? Because now we're in that $6 to $10 million range, right? And saying, hey, when you're 10 to 20 and 20 to 30, we're going to hit our own tipping point soon, where, all the less than 5 million knock on our door we talk to, as we get to 10, 20, $30 million of revenue ourselves, the people that are knocking on our door are going to change as well, because upstream, a lot of the players are consolidating us as well, right? So we're looking at the downstream. There's much bigger players upstream. We're going to cross paths in the near future. And then it's a decision of what we do from there.
And then so just moving to the organic part of your growth. So right now, your revenues are still pretty skewed towards the marketing part of your business. So how do you see that mix evolving over time as you cross-sell and add more on the payments and point of sale solutions?
Yeah, like more than 80% of our revenue is the marketing business today, right? And so, less than 20% is payment and point of sale. So it's seeing more of a blended approach there. And I think where we'll see a lot of growth are those two areas. It's where even in Q1, it's the last day of Q1. we saw the most growth there. Our point of sale business, even though we're normalizing it, we're seeing a lot of attention, and this will all pay forward in future quarters. But I think we're going to see an evening out of revenue over time. But you'd be surprised, the marketing business, even despite COVID, has grown, even organically, right? Even through the attrition that we've had, we've outgrown the attrition through that mid-market customer segment. The small guys have struggled. The big guys are actually pulling back budgets. The mid-market has actually continued to spend, but it's the small and the big that haven't. That's where all the pullback has happened that we've noticed.
And then as you guys try to expand further into the US, what's your strategy there? And is it a similar strategy to what you've been employing in Canada, or do you have to differ?
I think it's the exact same strategy that we had in Canada. And to be honest, when the business first started, we were in the States. But after I took over, we kind of pulled back a little bit. And you kind of want to go down through partnership first and acquisition second, ideally. So how do partners take you down there that already have a presence and a customer base, and you kind of have a presence through partnership or through acquisition, where you actually get a client base down there? You get some staff down there. So both through partnership or acquisition is how we'll probably grow through the US. And even the growth that we've had thus far has been kind of through that. You know, First Aid has been a great partner to the US for us, right? And acquisitions have clients down there. So the same way we've grown Canada is the way we've been growing the US. But I think once we get a bit more stranglehold, it won't be so dependent on those two streams. We'll just organically do it.
And then I do just want to get to a few quick audience Q&A. Sure. What's a good organic growth number to use going forward?
I think, any business, because we're always acquiring, to be a 10% organic growth business or better in a space like ours, especially as our revenue keeps growing, is a good goal for the business. So our hope and our expectations from our plans is to grow at least 10% per year organically.
Okay. And then is there a risk that your largest customers may outgrow your solutions?
Yeah, I think what's interesting is you look at companies like Starbucks, right, on the marketing side. They went and they purchased, and I forget the numbers, something like $67 million. So there is a size that when our customers get really big, that they look to custom build or custom pay or buy a small business themselves. So it does happen where at a certain size, but that's yet another reason why that sweet spot of mid-market works well for us, right? Like those large enterprise customers, it's true. When they get really big, they probably will invest in their own tech, in their own solutions. But even those big companies, when it comes to payment, they still need payment. When it comes to operations, they still need a point of sale system. So they may choose a marketing platform that's unique to them, but we have multiple solutions now as we're scaling out that should cater to even the big guys. But really where we're focused is that mid-market business segment.
Okay, and then I'm just so that's the end of the Q&A. So I guess just one last question for me, what should investors be watching for, for Ackroo over the next few months?
I think, we've talked about some of our advancements in marketing. I did a press release last week talking about integrations and what we're doing from our marketing platform. So there's a lot of marketing advancements that are happening this year to kind of round out our product. We're also getting some legacy technical debt off the table. So you'll see a bigger embracing of digital marketing and online marketing advancement this year. So you'll see more announcements from the tech on that side of it. There will be acquisitions that will happen this year. It's just a question of which one and when. Again, there's that finessing between what's the right timing for our business to take it on and what's the right strategic decision for the business. But also, I think it's seeing that location count grow. As that location count grows and seeing that revenue per location grow, I think these are super smart indicators for investors to be watching. Having us go from 5,000 to 6,000 locations and having our $99 a month on average go to 110 and 120, seeing those metrics move will be big indicators that we're on the right path, not just inorganically, but organically.
Okay, well, thank you so much. We really appreciate having you on, and it was great. So
thanks for having me, Victoria. I enjoyed the conversation as well.
Thank you.